Where did you grow up? You worked at Aramco for a bit. How was that experience? And then how did you find yourself at Harvard?
I was born and raised in Jeddah. Actually, most of my life I spent where my office is now. So, home in this neighborhood. High school, I went to a public school. I did work in small and medium companies. My mom was a teacher, but she was entrepreneurial in the heart. She had co-founded a lot of businesses, exited businesses. Not all of them were successful. Actually, most were successful, and you learn the best from unsuccessful experiences. Well, the first time I heard of search funds was at HBS, Harvard Business School. Then after graduation, this is when I joined the Aramco college degree preparatory program, CDP&E.
Interesting. And what makes the search fund model compelling to aspiring entrepreneurs?
The idea of this investment model was founded in Harvard in the 1980s. Well, first and foremost, I would say financials. 35% is the average, actually, IRR for search funds globally.
Hi, everyone. My guest, Ghassan Ayidh, is a Harvard MBA who has returned to Saudi and established what is probably the first search fund in Saudi Arabia. A search fund is a vehicle for an entrepreneur to acquire an established business, and it is an alternative path to entrepreneurship. This episode was a masterclass in all things search fund. So if you are someone who is interested in entrepreneurship, but you don't necessarily want to start a business from scratch, this episode is something that you will find extremely useful. Hassan, welcome.
Thank you so much.
So I wanted to just discuss the search fund model. It's not something that's very well known. You recently raised a search fund. Could you explain what that is exactly?
Okay. I'll go with the pure definition of a search fund. Then I'll go with the generic definition, which I use 99% of the time. Search fund, or else known as entrepreneurship through acquisition, is basically an entrepreneurial path where one searcher, or sometimes they call him the principal, assembles a group of investors to search for, acquire, and operate one single small to medium private company. Now, sometimes it looks complicated, but it's basically a person that's called the searcher that gathers a group of investors, and they provide him with the working capital to search for a company. And once he finds a company that meets certain parameters pre-agreed upon initially with the investors acquire the company. Then the searcher moves to the company, operate the company for a certain period of time, and then they exit the investment. A lot of people think of a search fund when they hear the word search fund as a fund, a structure of a fund where there is management fees, so on and so forth, but it's actually not. So the search fund the traditional model happens in 5 stages. The first one is where you raise the initial capital that you require for searching for a company. The second stage is searching for the company, and probably this is where the search fund name came from. That usually the average industry is 2 years, and that's usually the standard agreement between the searcher and the investors. And then the third stage is acquiring that company. Then the fourth stage is operating the company. This is usually the longest stage. It goes between 4 to 6 years. And the searcher himself operates the company as a CEO or a general manager. And then 3 to 5 members from the investors become board members in that company. And then the fifth stage or the phase is exiting the company. All these 5 combined are called a search fund. Now, is there a fund structure per se? No, it's not. It's usually much simpler than that.
Interesting. And what makes the search fund model compelling to aspiring entrepreneurs?
For entrepreneurs, well, first and foremost, I would say financials. I don't like to hide this fact. After acquiring the company, once you become a CEO, you get up to 20, if you're a single searcher, you can get up to 25% of the common equity of the company. That's vested over 3 stages. The first one is once you complete the acquisition, you get 1/3 of that. So 8% of the company once you complete the transaction. The second 1/3 vests over 4 years. So every year you get around 2.1%. So by the 4th year, you've accumulated around 6.67%. Then the last 1/3 is by the hurdle rate that you achieve for investors. Anywhere less than 20% IRR for investors, you don't get anything. Anything above or 35% and above, you get the full 8.3. So that adds up to 25%. So that's the first reason. The second reason is, I would say, you work on your own, you do everything on your own, you're a leader on your own. Lastly, and the third reason is with the market shrinking, especially, I wouldn't say in Saudi, more applicable, but globally for post-MBA students, it's one of the opportunities that post-MBA students can go for. These, I would say, the main three reasons for entrepreneurs.
What did you mean by the market shrinking? You mean just like uncertainty and
The job market, no, the job market. So post-MBA, especially from elite programs, are not finding jobs that are paying. So the jobs that used to pay high for post-MBA students coming from elite universities, these jobs are not available as much as it was 5-10 years ago. I wasn't there, but this is from what I read. So there is a huge attention to the search fund model.
Okay. And you mentioned the hurdle rate of 20% IRRs. That's a very high hurdle rate. I think there's a lot of information. 35%.
So 35% is the average, actually, IRR
Yeah.
for search funds globally. 25% is the equity that the searcher gets of the common equity. So let's say you exit the company and the company valuation is, or you exit the company for 100 million and you hit an IRR through the investment period of 35% or above, you can get up to 25% of that 100 million. So 25 million in this case.
Okay. So the hurdle rate there's a range, I'm sure, but it's about 30-35%, as you mentioned. So that's what makes this model very compelling for investors, that search funds can actually achieve these ridiculously high returns that would be very difficult to find in public equity, private equity, even venture capital, unless you're the top, 5%, 1% of venture capital firms.
Yeah, that is definitely correct. This is one of the most attractive things for search funds when it comes to the investor perspective. And that's almost double the performance of private equity and VC, let alone public equity. And the average multiples on invested capital goes up to 5 multiples. And yeah, this is one of the angles. Then you have the downside protection. So for investors of search funds, you're investing, let's say, in 20 searchers around the globe or in a certain region. But that doesn't necessarily mean that you're investing in all of these companies. As an investor, you have oversight over the entire market and you have 20 searchers, so you can pick and choose whom to invest in. So it's like, I would say, hiring 20 private equity professionals in different regions, and you pick and choose which investment opportunity that pick. So there is somewhat of a downside protection. And if you lose your initial investment, it's usually nothing compared to the actual investing in the company. So that's another angle to look at from an investor perspective.
You mean at the search phase, right?
At the search phase. So as I mentioned, it's 5 stages. They invest initially working capital, so something that you use for daily salary, for due diligence fees, administrative fees, so on and so forth. And then when the searcher finds the company on the 3rd stage, they acquire the company. This is a second capital call, and this is where the bigger capital comes. So if they invest in 20 searchers, that does not necessarily mean that they have to invest in 20 companies. They have the right to pull from the other investments. And I'm sure we will get to that question down the road. What are the investors' rights after they invest in the first stage?
Yeah. Interesting. Yeah. So basically, the investors put in a certain sum of money in the initial phase just to fund the search. If the search doesn't go through, they only lose a small percentage of their money or a very nominal amount of capital. And if it does go through, then you have the optionality to potentially get 35% IRR.
Or you have the optionality to say no, and then you get a 50%. That searcher has to find another investor that replaces your place and gives you a 50% even step up. So that's another good thing about search funds, and we can speak about that, the two rights of investors.
So when did you first hear about search funds? How did you come across it, and what made you decide to pursue this path?
Well, the first time I heard of search funds was at HBS, Harvard Business School. So I'll probably use HBS a lot in our conversation, so let's lay it out from now. And the search fund was actually founded. The idea of this investment model was founded in Harvard in the 1980s. I think it was 1984. And now it has become a science. There are several books written about it, and they teach it in classes and at HBS. So the first time I heard of it was in my first year at HBS. It wasn't a class. It was one case of an entrepreneurial operation management class. And this is when I was interested in it at first. But I've heard not before HBS, from my friends in class, my classmates, people who are thinking of doing it. So this is when the word search funds first came around. Then I took this class. I understood the model a bit more. But then the second semester, and then I worked in the summer internship. I did my internship with a small private equity boutique shop. Then I understood the investment. I come from an engineering background, background experience as well. So learning about the search fund, the word, the terms in the first year was not as tangible as it was after I finished my private equity experience. I understood the returns, understood the process, understood the market. Then in the second year, I dedicated almost 90% of my second year to understanding the search fund, practicing actually the search fund model, and doing fully 2 independent projects on search funds. So I would say Harvard, I did not hear of it before Harvard.
Okay, what were those projects, just out of curiosity?
Yeah, of course. I did my first project was looking into the different investment vehicles that I could do after graduation. I was thinking of getting into the investment field after graduation as a long-term career. So my first independent project was with one of my finance professors, and it was purely about studying the different investment models and which one would be more applicable to me in the Saudi market. The second one was purely search fund, and it was with my 2 ETA, entrepreneurship through acquisition professors. They're actually the writers of HBR Guide for buying a small business. And that one was building my investment thesis because it was in the second semester of my second year, so last semester before graduation. After I have decided fully to commit my full-time post HBS to search funds, this is when I took this independent project, and it was purely about building my investment thesis for the search fund. And this is the investment thesis that I used during my fundraising. An independent project, just to give you a full picture, it's either you sit one-on-one with the professor or you sit with a small group of people. In my first semester case, it was one-to-one with the professor. In the second semester, when I built my investment thesis, it was with a group of other searchers who were thinking of doing a search fund post graduation. So it was 8 or 10 of us, and we would meet weekly for an hour or 2, and we would discuss the different aspects of search funds. So some people were searching, some people were trying to fundraise, some people were at the final staging of building the investment thesis, and this is where I was.
Okay, interesting. We'll get to your thesis later. Before that, I would like to just briefly touch upon your background, how you got to HBS in the first place. Where did you grow up? You worked at Aramco for a bit. How was that experience? And then how did you find yourself at Harvard?
Well, sure, of course. So I was born and raised in Jeddah. Actually, most of my life I spent where my office is now. So home in this neighborhood, the neighborhood. High school, I went to a public school. I did work in small and medium companies. My mom was a teacher, but she was entrepreneurial in the heart. She had co-founded a lot of businesses, exited businesses. Not all of them were successful. Actually, most were unsuccessful, and you learn the best from unsuccessful experiences. So I spent a lot of my childhood working within the family. And then after graduation, this is when I joined the Aramco college degree preparatory program, CDP&E. So they basically take you for 1 year with Aramco, then you go overseas to get your bachelor's degree. I went to Oregon State. My background is in chemical engineering, and I got a minor in business and entrepreneurship. After finishing school, this is when I went back to Aramco. I worked for 6 years. I did 1 year in operations. I did offshore operations. So I was working in the Gulf as an operation engineer. Then after that, I worked in Safaniya. Both of them were Safaniya fields. One was Safaniya offshore field, and then my project management was in Safaniya onshore. I spent in projects 5 years, so that's a total of 6 years. But in my last year in projects, I mainly managed one project. A lot of people move. Naturally speaking, in projects, there is a high turnover rate in employees, because employees move from one project from one area to the other. I stuck to one project that I call, sometimes I feel jealous of business owners and how they feel towards their businesses, but I can say that was my baby project. I enjoyed it. I spent 4 years in that. And my last year, I did a dual role. So I was working on a new business development initiative with one of the executive leaders in Aramco, and at the same time, I took up on a program controller role. My first role in projects was executing one project. The second one was basically overlooking multiple projects from a financial perspective, from planning perspective, from a more administrative perspective. So after I did that experience, the last one, and especially working on a new business development initiative, I was more exposed to the finance of things, and I got really intrigued. And this is when I applied for my MBA at HBS. Thankfully, with the support of everyone around me, professionally and personally, I got accepted. I left Aramco because I knew I wanted to pivot around a more finance career in the future, and more specifically around private equity or consulting that does anything related to private equity. So due diligence studies, market studies, so on and so forth. And then went to HBS. I did my internship in private equity, and then I graduated HBS and I started fundraising for the search fund.
Great. And at Harvard, which courses or classes and professors did you find the most useful, the most interesting?
I wouldn't expect myself to say anything different than anything related to ETA. First year was mostly mandatory courses. My second year was the elective year. This is how it goes in at HBS. First year, everyone takes the same classes. Second year is where you get to select your own courses. So I would say all the classes that were related to managing small businesses. I did strategy classes, I did finance classes, and then I did entrepreneurial classes. And the most one I would say that I was drawn to, and the ones that had the biggest impact on me were the entrepreneurship through acquisition classes. There were two. The first one was financial management for smaller firms, more like an HBS typical format. You study cases, you read cases about previous search funds, former searchers, what they did, successful ones, ones who failed. And most of the time they bring, or 90% of the times they bring the protagonist, so the searcher, the person who's mentioned in the case, to class to answer our questions. The second one was called Entrepreneurship Through Acquisition. This was more of a seminar format. We take 2 hours per week, and it was basically a class going through the different stages of the search fund. And you actually get to choose a company, you look at the company financials, you evaluate the company, and then you build your investment deck. And then the last class, the professors would bring actual investors and you would pitch this investment opportunity to different investors. And the two professors, Rick and Royce, they're the writers for the HBR Guide to Buying a Small Business. Those were one of the most influential professors. I mean, evidently that I'm doing search funds now. And they were supportive also after graduation. And I have a list of many other influential professors.
So when did you officially start your search fund journey? So you decided you wanted to do search at HBS. When did you say, okay, this is what I'm going to do? And then how do you start a search fund?
Well, I did that after the first independent project. So after the first semester, I'd say August of 2023. After I decided I'll do a search fund, I started learning. So search fund, it's not an overnight thing. You build experiences over multiple things in terms of sourcing, searching, how to build a pipeline, how to communicate, building a deck, introducing yourself to prospective sellers. So I started with that. I started learning how to utilize CRM to build a pipeline, to manage my pipeline. And I learned this from a lot of my network and friends at HBS. This is how I started. Then after the first semester, I actually came back to Saudi during the winter break, and I dedicated the majority of my time to meeting intermediaries, business owners, trying to understand the market. Because the first thing that you hear when you're mentioning a new idea everywhere, that doesn't work, that works somewhere else, but it does not work in Saudi. You probably experienced that also doing anything in your life. So this is the pushback that I had at the beginning. This is applicable in the US, it's not applicable in Saudi. But then when you look at the facts and the numbers, it's applied everywhere. So I needed to practice the model myself and do it on site. So that's what I did in the winter break. And then I was fully determined that it's actually possible. There are sellers that don't have any exit opportunities for their businesses. A fun fact that a lot of the businesses that I spoke to during that period, so we're talking January of 2024, it's been a year, or even before that, August of 2023. So we're talking almost 2 years. some of these businesses actually did not go out of business, but talked to few that revenue declined over time because the sellers or the owners at some point, they become more interested in stuff than the business itself. And sometimes they give the management of that business to someone else. They don't overlook the business. So this is when I decided, and this is what I learned first, building a deck, looking at how to manage my pipeline, how to source companies. And it went on from there. I was going to do a self-funded model to start with. And then after graduation, so we're talking May of 24, this is when I decided I'll do the traditional search fund model. But I was eyeing to do a self-funded model.
Okay, so self-funded, just for those who don't know, is it means that you don't
yeah
capital first.
Yeah. So very quickly, there are two typical models for search fund. There's a traditional model where you go through the 5 stages, and then there's a self-funded model where you don't need the money to perform your search in the second stage. You just jump to the third stage. You have money. Some people do it part-time in the US because you have listings, you have many resources to find companies that are offered for sale. So they don't quit their jobs. They keep looking for companies while they're on the job. Or in some cases, people have the capital to actually search on their own. So it's called self-funded. You fund yourself for the search. Once you have the company, you go out and you get the capital to acquire that company. There are differences in the equity split. So in the traditional model, the searcher, which is me in this case, I can get up to 25% after we exit the company. In the self-funded model, however, you can get up to 70% of the equity. Yeah, because you did the search on your own. They use leverage in it. So they're only asking for 30% of the equity that's being put, or 25% from the investors. It's a negotiable rate. I've heard as low as 60-40 and as high as 75. Yeah, so for the self-funded model, because you founded the company, you can get up to 70%. In very rare cases, it depends on how you structure the deal and how much equity they're putting in the deal. But it ranges between 60 and 80% in most cases. While for the traditional search fund, for a single searcher, the maximum you can get is up to 25%. And for the dual searchers, you can get up to 35%. Both get up to 25%, not each. And vested 1/3, 1/3, 1/3 for the traditional. Leverage is a growth lever. You have 3 growth levers in growing your investment. The first one is growing revenue over time. The second one is growing the multiple, or making the business, boost the business model. So you acquire a business that doesn't have recurring revenue, you switch it to recurring revenue, you buy it for 3 multiples, you sell it for 6 multiples. So imagine, let's say you buy a business that's making 3 times 1, and you sell it tomorrow for 6 multiples, 6 times 1. So you made 3 additional dollars or whatever. That's the second. The third one is buying through leverage. So you're buying a company that's worth $10, and you're putting down payment $1, and you're getting a loan for $9. You keep everything the same, the multiple, the revenue, and you pay down the debt. You sell the company for the same price. You're making $10 out of the sale. So you paid 1 and you got $9. So that's the third growth lever. So the short answer, of course, in terms of financing, it does make a difference, but that does not constitute that this is the only growth lever. You still have 2 other growth levers. So if you're special and if you're going in an emerging market, you can play with these 2 growth levers to grow your initial investment. As a matter of fact, the highest performing search funds, the ones that got 30 plus multiples on invested capital, they grew all 3, but majority of the growth came from the revenue growth. So I wouldn't say it's wrong. No, of course it's right. Having leverage is a huge growth lever when it comes to investment. But you have to look at your market. In Saudi, when I decided, for example, in my investment thesis, I had to look at the industries that has the highest growth, future growth, in terms of business, in terms of multiple and how you change the business that comes after you acquire the business and when you're evaluating businesses, and businesses that are accessible more to debt. There are certain industries, industrial, for example, it's more accessible to debt facilities. Industrial factories, you can get that has a collateral on the heavy assets or actual assets of the business. And now I heard, I did not verify that, you can actually get loans or credit facilities based on the receivables of the business. So there are ways to work around these limitations. Leverage buyout is a great thing, and especially in the US, a lot of people give the US as an example. In the US, the amount of self-funded searchers is massively a lot than the traditional search fund entrepreneurs. Why is that? Because they have something called the SBA loans. I guess SBA stands for Small Business Administration. So if your business valuation is less than 5 million, you can get, it's like this SME bank in Saudi, but that's in the US SBA loans. But you can use that loan to acquire a business. And if the business value is is within $5 million, you can actually get up to 90% of the business value from the bank loan. So let's say a business of 330 discretionary annual SDE or annual EBITDA. Let's not use SDE. And you buy the business for 3 multiples of that annual EBITDA. So 3 multiples of 330, let's say 1 million. You can put $100,000 and then get a loan for $900,000. And the only thing you have to do is just make sure that you use the business cash flow to pay down that debt for a 2.5% interest rate, I think. It's very cheap loans. So that's why the search fund model is more applicable in the US. In terms of facts and numbers, the recorded search funds globally are around 1,000. 670 are in North America. So we're talking US, Canada. We don't know if Mexico is included in that study or in those numbers. But then the remaining 300 or 300 and something is global search funds. So the only country that offers, I think also in Canada, it's not as easy to find loans to buy businesses as it is in the US. So the US, of course, special case, but that does not necessarily mean that it's not applicable in other countries. You can use the 2 other levers. If we speak about Saudi in terms of growth and what's going on with the economy these days, there are multiple growth avenues that you can grow businesses. And this is what I put not all my eggs, of course. Oh, and one thing I want to mention, that's when you're getting the loan from the bank. There's another debt element, which is seller financing or forgivable seller notes. So you're telling the seller, your business is worth 10 million riyal. Help me with 30% of the business price. That's not an easy sellout, by the way. I figured it's so tough, business owners. When you're telling them, I'll give you 10 million, they want 10 million. But you can't. There is a concept in the market called seller notes. So you tell the owner, I'll give you 7 million now, and I'll pay you from the business cash flows the remaining 3 million over 2 years, or whatever you will deal with an interest rate, of course. So that's another avenue. So you're not getting the 90% leverage. You're getting 30, 40% leverage. If you can get then debt for 10% and then 30 to 20% seller notes, and you pay down the remaining 50 to 70%. So you still have a taste or a flavor of the debt, but it's not called a leverage buyout. The leverage buyout is where you leverage most of the purchase price. And that's how LBOs are done, and that's how private equity firms make their money. So the 3 levers in growing a private investment are normally growing revenue. So you buy a business that's making 5 million annual revenue, and you sell it after 5 years, but then after 5 years, it's making 10 million annual revenue. That's one growth. You grow the size of your investment. The second one is you buy a business at 3 multiples. Let's say you use multiples of EBITDA. The business is making an annual EBITDA of 1 million riyal. You buy it at 3 million today, and tomorrow you sell it for 6 times EBITDA. Now you're selling it you bought it for 3 million. Now you're selling it for 6 million. So you made the delta, which is 3 million. So that's a second growth lever. The third one is leverage, not putting your money all in. Let's say you bought a business, the purchase price for the business was 10 million riyal. You didn't pay from your own pocket money. You paid 1 million and you got a loan for 9 million. All you have to do is just pay down the 9 million. I'm making it easy, but of course you have to use the cash flow. You have to manage the business. You have to manage paying down the debt. But you pay down over 5-6 years the value of debt, which is 9 million. Then you're selling the business. Let's assume everything is constant. All the other factors are constant. Now you're selling the business for 10 million. So you made 9 million riyal. So 9 over 1, you made 9 times your initial investment. Now, investments usually are a mix of all. But you will find some people that make money on leverage, some people that focus only on the multiple, it's investment thesis and how you build your investment thesis. So my investment thesis, basically, I was a generic search fund investment thesis. And then the narrower part was regional, which is specific to Saudi. In terms of the 3 levers, of course, I had a mix of 3. You have to present different scenarios. So you have to tell investors, if I buy this company and I put this much leverage on it, and the revenue is growing at 10% annual rate for the next 5 years, then what if it's growing at a 5% rate? So those are called sensitivity analysis. So if the business grows by this many years, if the EBITDA expands by this much percentage year over year. But in terms of investment thesis building, first of all, you start with the broader filter, or the biggest filter, which is you're only looking at small to medium companies. So the average employee is between 10 and 250 in our case in Saudi, or some cases between 10 and 299, 10 and 300. So in Saudi, for example, we have 1.3 small and medium companies. Those are micro, small, and medium. Micro, 1 employee to 6. Medium, small, between 6 employees and 49. And then medium, between 50 and 249. I'm talking munchat numbers. Then there are different numbers in the market. So I'm not looking into micro businesses, 1 to 6 employees. I'm mainly looking between small and medium businesses. So 6 employees to 249 employees. That shrinks it down to around, I forgot the specific figures, but a little less than 300,000 businesses. Then you want to shrink it down by region. I'm focused, for example, I want to focus on Jeddah and Riyadh. Why? Because 67% or around 60% of small medium companies are in those two regions. Now you shrink it down to below 100,000, let's say. Then it comes to the more regional focused and the more focused investment thesis that's related to Saudi. In my case, I wanted, as I mentioned, I have 3 growth levers. I wanted an industry that's growing, that has a bright future in Saudi, and I want an industry that I could actually find financing for, or I could convince people to give me loans in, whether in seller financing and private credit facilities, so on and so forth. For me, and touching on my previous experience in terms of supply chain, project management, operating, those for me were industrial, healthcare, and logistics. So the broader theme was I want small to medium company. That's in terms of search funds. That's the size of what search funds investors invest in. Roughly between $1 million to $5 million annual EBITDA for me, or anyone can translate it in terms of manpower. So between 10 and 250 employees. Then it comes down to regional focus in terms of Saudi, which one has the highest growth, which industries has the highest growth, and which industries could be more accessible than other industries in terms of leverage. Then the last one comes down to the business model. So which business model has the highest margin? So within these 3 sectors, healthcare, industrials, and logistics, which one has the highest EBITDA margins as a cash flow for the business? Of course, not in all cases, but assume it's a cash flow of the business. So you want high EBITDA margins. You want high cash flow for margin from the business. You want businesses that has high recurring revenue. You don't want project-based businesses that you might invest in the business now, you buy the business, and tomorrow you lose all the projects that you're bidding for. You want low cyclicality in the business. You don't want businesses that has revenues going up and then when you're going down. You want consistent growing revenue. That's the last filter, I would say, in terms of business model. So for me, in my case, for example, those 3 industries, healthcare, logistics, and industrials, were split further into something above 40, I think 40 or 41 subsectors. And then from those 41 subsectors, I actually evaluated each subsector in terms of EBITDA margins, in terms of competitive barriers. You don't want an industry, a subsector that has very low competitive barrier. So anyone could tomorrow jump in and compete with you in the market. In terms of fragmentation, you don't want to go into a super consolidated market. For example, let's say oil and gas. Aramco will be number 1. I don't want to go into a market. As an example, of course, oil and gas, you can't even get into it. But you don't want to go into a market that has one player that constitute 80% of the market revenue, of the market size. You want an industry with low cyclicality, so non-commodities, non-oil, non-chemicals, non-grains, so on and so forth. And then you want a subsector that has future growth. Out of these 41, I shrank down to 5 to 7 sectors. And most of that I did during that second semester, or the independent project, the search fund independent project. Basically, for the investment thesis, you're looking at the market pain point and to streamline your efforts in finding a business. Otherwise, if you go out in the market and you look randomly for businesses, you'll get lost. So that's basically what an investment thesis is. I was actually surprised, and I was just telling my interns yesterday that a lot of people think that Saudi does not have market data. But if you look in terms of growth, you'll have market data from research centers. So you have market intelligence, model intelligence, so on and so forth. They're endless, actually. You don't know which one's right and which one's wrong. ChatGPT, it actually, if you do a deep research, it gives you the resources and it gives you multiple studies, and you pick which one is the most appropriate. You can look into these resources. But I would say that this is not enough. I was telling my interns yesterday that we think that Saudi does not have a lot of data. But if you focus on a certain industry and you look into the associations, authorities, ministries' websites, and open data for the General Statistical Authority, GSTAT, you'll find a lot of data about the Saudi market. Above all, you're not only relying on data. So for me, it was studying those reports, looking at these reports, putting my matrix, so different subsectors, measured against these criteria. But then I had to verify my studies with industry experts. So I called investors who invest in these sectors. I called operators who operate businesses in these sectors. And I also called experts, general experts. And sometimes I'd call them SMEs, subject matter expert in the field. They've worked as an operator, as an investor, as a business owner, and you gather more information about those sectors. And if these interviews match your output, then you just proceed and you test. There isn't right or wrong answer. You actually have to test. For example, I looked at a certain subsector, and the more I looked into, I listed down the businesses within a certain region in Saudi in that subsector and started calling CEOs. But then I figured that my initial investment thesis was not right in that subsector. And that's why it's called entrepreneurship through acquisition, because you're pivoting your sub-industry, and you're learning along the way. I would describe this as the roughest period of my life in terms of uncertainty, whether it's going to work or not. The way I anchored an investor, a global investor. So for the global investors, they have institutional investors that only invest in search funds. And I am actually very grateful for being in Harvard. You're usually under the spotlight, especially if you're in an emerging market. No one's competing with you in terms of small businesses, and you're graduating from top university. There is usually a higher chance in acquiring or finding a business, whether they participate or not. So my very first international investor was I met at HBS. So if you remember, I told you I started at the end of my first semester, and I was thinking of doing self-funded. So I had an interaction with this investor, and immediately after graduation, after I switched from a self-funded model to a traditional model, I spoke to the same investor. And I started the process. So when it comes to global investors, they have usually a standardized model because they're investing everywhere. So once you anchor that, you come to the local investors. Local investors is completely, you're fundraising for a new idea. So since no one has done it before, the traditional full model. So it's like fundraising for a startup. And my very first investor was a company that invests in small, medium companies. And they had a successful story within the small, medium companies businesses acquisition. And one of their team went to a top MBA program as well. So he heard of the search fund model. So this was the click. Once you have that second investor, local anchor investor, other investors feel the trust. I don't want to let behind or let down my network and friends. They were actually very helpful. Also, my cap table is composed mainly from the local perspective. Is composed mainly from investors that invest in small, medium businesses, investors that have experience or have pain point when it comes to the small, medium market, and also investor intros and support. I remember I would speak to my international investors and I would tell them, hey, by the way, because also international investors would put a condition that I have to get at least 33% of my cap table to be coming from local investors, just so they gain confidence that local investors actually believe in the investment model. It can be applicable to Saudi. So I would go and whine to my international investors. I'll tell them I couldn't get local investors. And they'll give me great advice that I used with my local investors. Also, some of them actually introduced me to potential local investors. And I don't want to forget my network, my very close network of family and friends who also introduced me. By them just introducing me to their network, that's a word of confidence for them. So I would say it was 90% anchoring one major international investor and then one major local investor, and then the support of that network of investors by introducing to other investors and close friends. I actually have one cold call for a local investor that I am very proud of. It was an investor that I don't know. I mean, I hadn't been introduced to through a network, but they were nice enough to actually hear me out and I just progressed through the process, and they came into the cap table.
So yeah, I wanted to discuss getting the investors on board. That was very insightful. You mentioned that you had a really good piece of advice from someone, from one of the international investors. What was that?
Well, it was about whom to approach. I reached out to over 300 local investors or potential investors. So anyone that has investing experience, say it in their LinkedIn profile, they've invested previously in companies. So one of the major advice were a list of the local investor characteristics that they have seen in other emerging markets. So local investors who graduated or had learned about the search fund model and during their MBA programs, family offices whose children went to a top MBA program and they heard about the search fund model, and investors that invest in small and medium businesses. And secondly is how to approach investors. When you're speaking to investors, you have to speak the investor, I would say, language. So if this investor is more interested in innovative investment models, you speak from that angle. If this investor is more interested in growing small and medium companies, you speak from that angle, so on and so forth. Those were the two major pieces of advice that I received, or at least the ones that I remember on the top of my head.
So you mentioned that this was one of the hardest parts of your professional career. Is there any instances that explains why exactly? Was it just because it was very hard for you to get initial feedback or initial direction, or what was the reason?
I mean, there is a huge psychological part to it, and I'm going to be fully honest on this. You're graduating from HBS, and you see at all the other HBS former colleagues or people who graduated within the same year, you see people that they're progressing, they're holding great positions, the pay is very attractive, and then I'm trying to do something that no one has ever done, and I'm not even sure if it will work out. And at the same time, there is no proof. And in Saudi, like I feel that a lot of companies care about this. Like you graduated from the MBA, what did you do in case it didn't work out? This always came to my head. How would I justify not doing anything after graduating MBA? So looking at others and what they did and what they have achieved 5, 6 months after graduation, and I don't have a fund yet. I mean, I have commitments, soft commitments, email written commitments. My success was measured by the funds transferred, because this is when the actual commitment. So yeah, that was the biggest part of it, and the uncertainty if it's gonna work or if it's not gonna work. But initially, once you have the investor confidence, I felt it is much lighter now, because with their support, and actually I see it now, with their support, I felt that the model would work.
Okay, and then obviously that was before. Now you close the fund.
Yeah,
And
now it was
the fund
doing
is
it.
on. Yeah,
Yeah, I'm speaking about the fundraising, not
yeah.
during the search process. So the search process is a different story. I mean, and I gave myself a timeline. So the average fundraise for the search capital, which is the first stage, globally is 6 to 7 months. I forgot what were the numbers. It took me 6 months to close, and I'm the first in Saudi. Alhamdulillah. Very grateful for the people around me and for my investors and the trust. But 8 months to close the contract, sign the legal paperwork, and then the funds transferred. So exactly 8 months from day one until I started formal searching. So giving myself that timeline and doing this full time, not having a second job. A lot of people would fundraise while they're on the job. I didn't do that. So I committed 100% of my time. I know it was going to be difficult, especially first time searcher in a new region. So limiting myself with this time limit made it also more stressful, because from what I know in the market, people closed in 6 months, and I was approaching the 6 months, and I was approaching closing. I only had probably 8% remaining, but it was just psychological pressure. But yeah, to answer your question, it was for the first stage, which is the fundraise for the search capital. The second stage, I have 2 years, and for some reason, I don't know why I'm having the same, I wouldn't say mental stress, but mental eagerness and hunger. Like I do actually want to close a transaction. There is a mental pressure of being the first search fund. I have to make it successful. I have to make it successful. So I want to get to the finish line of acquiring the company. Will I have pressure or stress after acquiring them? I am pretty sure I will. I think it's just within the head.
You did mention that it's important to have an anchor investor internationally and locally as well. Why internationally? Is that necessary? I know in search funds, people generally the ecosystem in the US is that the investors go on the board and help train the new CEO. Is that something you're expecting from the local investors or the international ones?
Well, if I get to rephrase the question, like why this list of investors, because I wasn't oversubscribed. I was also, since I'm the first one doing it in Saudi, I was, compared to what I heard in the search fund community, I was pretty limited with the amount of investors that joined my cap table, I would say. I was oversubscribed towards the end, like the last 2 weeks or the last 1 month. All of a sudden, I have 4 other investors that are interested in investing, but it's the selection of investors. In terms of selection of investors, you have to think of the 5 stages of the search fund. You're searching for a company, you're executing a transaction, you're operating the company. So having global investors, first of all, I would say, gives confidence to the local investors in investing in this search fund model. That's number one. Number two, you're searching for companies. So you want investors that have a vast portfolio of other search fund entrepreneurs that you can gain experience from. For example, 2 weeks ago, I had a call with, in the past 1 month or 2 months, I've had calls with the first searcher in Dominican Republic, in Chile, in Turkey, and a few other countries. So I spoke to the first time searcher in that country so I can understand what they did in terms of searching and sourcing companies, especially in those cultures that has a lot of common grounds and common values with the Saudi culture. We know we're families. We're not single communities. Like a family has all the relatives living within the same probably neighborhood, and they will inherit the business. How do I find businesses in those cultures? So you want investors that have a massive amount of searchers within their portfolio. So that's in terms of searching. In terms of executing a transaction, even prior to executing a transaction, you want investors that have experience in negotiating small and medium businesses acquisitions. So that's what you want to think about. And then executing the transaction in Saudi. And that's something different. So we want investors with experience in executing transactions for small and medium companies in Saudi. Then you want to look at investor operators. I have former searchers who have invested in my search fund. So they actually have been through the entire 5 cycles. This is one of my investors, 2 of my investors actually. And every time this investor tells me something, it actually applied to him 10 years ago during the time when he did his search fund, and it does still apply to me. Like we have very similar stories that are going for both of us. So you have to think of these different stages and design your cap table as you're designing your dining table. So who do you want to sit in your dining table? Lastly, I would say it is important to have investors that you feel comfortable talking to, because you're engaging with a lot of these investors. So it's not, I would say, having an international investor just for the sake of it, or no. It's the values that you're gaining from these international investors are not, you can't find in local investors. And by the way, I described this to the respective sellers. Oxmar Partners is not a one family office, does not bring one perspective on the table. It's 17 investors that are coming on the table. I have entrepreneurs, search fund entrepreneurs, pure investors, family offices, institutional investors. All of these, 5 of them will become board members, but all the others will have skin in the game. So you're in growing the target company in the future, you're not bringing one perspective, you're bringing a wide array of perspectives into the table. I'm sorry if I digress, but they're all
No, amazing. That's exactly what I wanted. That's exactly what I wanted to hear. That's very insightful. So now moving on to sourcing, can you tell me how sourcing is going right now? What are you expecting in the coming few months, coming year?
Sourcing, I would comment on sourcing up to this point. So considering the start period, which is August 2023, up to this point, has been going well. I started with intermediary approach. So I would reach out to intermediaries and they would let me know if they have any potential target that fits within my criteria. I've seen interesting deals, seen interesting companies. Now I'm trying to switch away to, because I was finishing up the industry analysis and looking at the different subsectors. Now I am actually looking into a proprietary outreach. So I'm communicating directly with business owners that are more plausible than others to sell their businesses. And that is alone is a very interesting experience. So I'm learning a lot. I'm meeting a lot of interesting people. And I feel that the great quality deal will come through proprietary outreach. So those people who don't know that they can sell their business, but they have an idea of trying to exit the business, but they haven't been offered the right opportunity to exit. So this is the perfect timing of catching these business owners. So I've been looking into businesses, looked at over 20 or 30. I haven't, but I looked at a bunch, signed NDAs, looked at a few, offered few, gave few an offer. It wasn't very appealing. That's another challenge, which is pricing businesses. Yeah, so I would say in general, it's going pretty well.
Yeah. How do you go about proprietary outreach? Is it just getting a database, maybe LinkedIn, maybe scraping websites, and then just reaching out?
Yeah. But before that, you have to just know what kind of how are you going to do that? If you remember, we spoke about the limiting. It's a funnel, 1.3 million. Then you go to 200, then 100 in Jeddah and Riyadh. Then by sub industry, 40,000, I think. And then you go by subsector. It goes between 500 or 5,000 businesses. Then you start finding these businesses. You can find there are multiple ways. There are specific platforms, sales platforms that gives you as much information that can be found about a certain business. You can use LinkedIn. You can use Google Maps. You say, I'm looking for this kind of business. Right? Let's say, for example, search fund in Jeddah. I'm not sure if you will find me or not. I don't have anything on Google Maps, but see the companies in Google Maps, do a quick verification and see if this qualifies as a business, then reach out to the business. Easier said than done. There are multiple platforms and means, tech utilities that you have to use. You have pipeline management system. You have communication systems, be it emails, bulk emailing, letters, if you want to do it. I heard some searchers do that, like they write actually hard letters. Then you have sourcing platforms, so platforms that show you information about businesses. Then you have extraction platforms. So, for example, if let's assume you're looking into the industrial sector. If you look at the Ministry of Industry, they have a website where they have all the factories in Saudi, the approved licenses and the amount of allowed or approved quantity under each license for that specific business. So you have websites or AI tools that you can actually teach how to extract information from these websites. So you teach it what to do in terms of limitations, size limitations. It goes into, you give it the link and it does extraction of information. And then you have the one and only ChatGPT and Perplexity, all the other AI tools. So I would say in terms of sourcing and listing down businesses, it's not one thing, it's a package of things. Managing your pipeline, managing your communication, your sourcing, your information extraction, then communicating to those business owners, then how you change that initial communication to an actual prospective seller. So you do actually communicate with the seller and explain to him what you're doing and see if they're interested. So it's changing the seller from one layer to the next in the funnel. So from qualified business to open to talk to, yes, I would be down to sell, to signing an NDA, to accepting an offer, so on and so forth.
You mentioned that you know, or you're looking for people who are likely to sell. Are these people who are generally above 50, 60 years old, or what qualities are you looking for?
Not necessarily. The search fund model was founded on these merits that a lot of business owners, the 50s and 60s generations, will come of a retiring age now, and they will exit their businesses. And a lot of these don't have any succession planning. But that's one. You can find second generation who are managing a company, but they have minority conflicts in between them, and they're not interested in managing the business. Someone else is managing the business, and they don't trust that someone else. They would rather sell the business, and if they're making 10% year-over-year growth, they'll put it in another private equity fund, or in Saudi, real estate is booming. Last year grew 20% year-over-year. They prefer doing that. In other regions, it could be there are a lot of internationals who opened businesses in the past 20, 30 years, and now they want to go back to their home country, but they don't have any exit means. So that could be a target. For me, it would be any of those, but the highest percentage of search funds is retiring baby boomers.
Okay. And since you've already started the sourcing process, could you give an example of one or two really good companies that you really liked and wanted to close on? And maybe an example, without giving names, obviously,
Yeah.
just
Oh.
what you liked about those businesses.
Yeah, I mean, I've looked at a few, I would say, medical manufacturer and distributor. I did look at another agricultural factory, another one that I liked but did not work out was an HVAC contractor. So small businesses that was founded by, and all of these met the search fund initial criteria, but they all dissolved for multiple reasons, either for pricing or for reasons that my investors opened my eyes to. I did not see at the beginning, in terms of risk associated with business, so on and so forth. But yeah, those are three examples. So all of these were legacy businesses, 40 plus years old. The founders are becoming of a retiring age. Not one of them, not the factory. It was owned by some investing entity that wanted to exit the investment. But yeah, those are some examples.
What are the red flags, and what was the thing that the investors pointed out that you didn't initially notice?
Well, one of the first things that I noticed and the investors noticed is the price. The ask price was very high. So one of these was as expensive as if you've invested in a similar company in the public market. And I was trying to convince the owner. I was trying to talk with the owner. How do I convince my investors to pay for a private company in an illiquid asset while they can do the same for a public market company? And so pricing, I shared that with the investor. One of them was actually decently priced, but then customer and supplier concentration, I see it a lot. So some businesses, the entire business was based on a sole supplier, and the supplier constitute about 50% one supplier. They have an exclusive contract. But then when you tell the owner, what happens if that one sole owner goes out of business or anything happens to that one sole owner, you lose 50% of your revenue. Another one was immensely concentrated around one customer, one major customer. Around 50% of revenues came from one customer. The last one was a project based, and they were pricing the business not considering the cyclicality of projects. So these are the three main factors that come on top of my head. I'm sure there are other factors, like I am recalling others now, but those were the main ones. So price was the biggest one, and the second one was customer supplier concentration. The third one is mostly project-based businesses.
Okay, great. And now, as you're looking to close soon, hopefully in the next, I think, year and a half, hopefully, or less. Inshallah, what are your aspirations for the company that you acquire in the future? Like, what do you want to do with that company while you're operating it, and what do you want to, how would you like to exit? Would it be to a private equity firm? Would it be to, would you rather go public?
I think I lost you, sorry.
Yeah, I was saying, what are your aspirations for the company, and how would you like to exit? Would it be a sale to another private company, or perhaps IPO?
Well, I would honestly lie if I say it's not an IPO. IPO is the most attractive exit for investors. My aspiration, 5 to 10 years, is a long term. You mentioned completing an acquisition is biggest target for me now. In terms of the business itself, my biggest aspiration is to maintain the legacy of the business, and that's the first thing that if you go to my website, it says it build leading businesses in the kingdom. I aspire to build a business that is headquartered in Saudi that provides services globally. So this is my longest term vision, whether it be a business that I acquire through the search fund or a business that I manage in my life. So this is my biggest aspiration for my career, is building a business that serves the world and that's headquartered in Saudi. My current mission to do that is to acquire a small to medium company and provide the highest shareholder value for my shareholders and investors. In terms of exit opportunities, as I mentioned, I would say I wouldn't lie and say exiting through an IPO is not the best for me and my investors, has the best returns, but it all depends on the investment on the company. Sometimes you think of going out to an IPO, but at the same time, if you sell to a strategic buyer, they might not pay as high, but they provide better acquisition structure. So in terms of exit, in terms of post exit structure, employment, so I can exit fully. They bring their own CEOs. While if you go on IPO, I have to remain as a CEO. So it all depends. But I certainly, one of my highest priorities is providing the highest shareholder value for those investors who trusted me at the initial phase.
Excellent. What advice do you have for aspiring searchers?
Searchers in general or searchers in the GCC? Those are two different answers.
Let's say in the GCC.
Well, first of all, I would say understand the model. Read about the model, understand the model. From my own perspective, I'm a searcher. I'm doing search funds. So it is most applicable in the GCC given no competition in terms of buying power. You're one of many, one of none. So understand the model, learn the model, speak to a lot of searchers. I spoke to over 30 searchers so far. Actually, I would say 50 if you consider, if you count in the searchers that I spoke to at HBS, easily above 50. And I continue to speak to searchers and I continue to engage with searchers. I'm in multiple search fund community groups, WhatsApp, online groups. So learn about it, read about it, understand the structure, understand the market, and speak to other searchers, speak to investors. Feel free to reach out. I'm always open. I always speak to people, aspiring entrepreneurs who want to become searchers. And once you're settled, you feel that you understand, whether be it you're doing a traditional or you're doing self-fund. If you're doing self-fund, make sure that you have enough cash because you don't want to reach a point where you're about to execute a transaction, but you can't because you don't have cash. But once you decide, and if you're doing traditional, approach investors as soon as possible. You want to approach investors as soon as possible because you want to get the word out. Because you'll never be, I think, in my experience, I wasn't as good as I was in pitching investors until I actually practiced investors. And not any investor. Every region investor acts differently. International investors act differently. Investors from North America act differently than the ones in Europe, than the ones in Latin America, than the ones in Saudi. They all act differently. So once you decide, learn, read about it, go and start immediately approaching investors. And the best way to learn how it goes is by actually trying it.
Okay, great. Usually I like to end the podcast with like some rapid fire questions that are somewhat outside of the
Wow.
main topic. So I wanted to ask, which is the one book that you would recommend to any entrepreneur?
I don't want to sound like someone who doesn't read books, but I actually read a lot. But I've spent my last few, I would say years, like the past 2, 3 years, is just reading finance. Because as I mentioned, I come from a non-finance background, so I was very interested in this sector. I would say Buy Then Build.
Okay.
HBR Guide to Acquiring Small Business is a great book about search funds, but Buy Then Build actually discusses the entire concept of entrepreneurship through acquisition. So it teaches you how you can be an entrepreneur, not by starting a new company, but by acquiring an existing business. And acquiring something is not always a business. You can acquire books of a business, customers of a business. And I feel that Buy Then Build gives you that. So I would say buy then build.
Do you listen to any podcasts? Anything you
Acquiring
recommend?
minds.
Okay, so
Very
your
good.
life is all acquisitions.
Search funds. Search funds. I'm all in and search funds. Yeah, all in.
And
There
your
are,
favorite
but since the discussion is about search funds, it's
your favorite restaurant in Saudi?
wow, that came out of nowhere. Uh, I would say the house. There are competing answers in my head. I would say in terms of food, I like Indonesian food. Then I would say Dandan. Not everyone has it in Saudi. There's one in Riyadh, new one.
No, I know the one in Jeddah, the one in Hira.
Oh, and that's near my house. That's like 5 minutes
Yeah,
away from my house. That's why I'm very addicted to Indonesian food.
it's good stuff. Was there something you wanted to cover that we might not have covered?
No, I did want to thank you for having this. Also, although I'm talking a lot, but it is very insightful when I speak of the things I do. I learn. A few things came to my mind. Why am I doing this as I was speaking? So thank you for this fun, very insightful for me conversation. Thank you for selecting me among all the other entrepreneurs out there in the Saudi market. I am very open for discussing anything about search funds, let alone discussing acquisition opportunities if anyone wants to. But people who are interested in the field, I'm very open. Feel free to add my LinkedIn contact or page or Oxmar Partners page. Yeah, thank you. I think we covered pretty much everything.
The best way for people to reach out to you would be LinkedIn.
Yeah. I'm very responsive on LinkedIn.
Okay. Well,
I'll
Ghassan,
reach out at the same time, then give me some time. But yeah, I'm very responsive. I try to be responsive very quickly.
thank you for your time, Ghassan. This was very informative, and I'm looking forward to following you throughout your journey.
Thank you so much, Muhammad. Thank you.